Hopefully nothing
It's an
happens.
executive officer decision.
We went to Italy to make
People
the
waiting.
pizza.
He ate the whole pizza.
There won't be too many.
Tony, if you can hear me.
Pizza and beer.
That's right. Talking bad.
Don't
Well,
even
nice to
start
tell ya.
without you.
They have half off on Tuesday night, not mine.
Alright, so before I start, are there any questions about loans in general? Before we get into the VA stuff?
I'm seeing interest rates are really low and really, really low.
4.15 the other day.
125.
4%
Is it
FHA?
4%, you can get 4%.
4%.
Yeah.
How much is gold for an ounce now?
I'm
1,900 and climbing?
On this side.
I'm not
I
sure.
can't see.
But rates,
And a 30-year fixed? The
Yeah.
one, the
You can get
4.125
Yeah.
30-year fixed?
Yeah.
Wow.
All I know is the euro's really still better than the dollar. But so if you're traveling, Mexico is probably the best destination where you have the most buying power. But any questions about loans in general right now?
I just had one question about the loan limits. Do you think Congress, I know there's a bill in front of Congress to keep the 729, 750 loan limit. Do you think that's gonna pass or do you think it's gonna die?
In terms of the lenders right now, they're all adjusting to the 625.
Right.
Our official deadline is the end of the month,
Correct.
which is only 8 more days, and then we have to lock it by September 30th.
So you're automatically reducing it to the lower amount?
Yes, that's correct.
But do you think they will still maybe pass it? What are you hearing, anything?
I think it's unlikely. What I remember before was when they made the change, it was a couple of months before it took effect, because lenders had to update the system again. So even if there is a change, it would probably be a delay.
They're still on summer recess after Labor Day anyway, so we won't get anything.
Well, the reason I ask is because it's gonna severely reduce the buying power of a lot of folks who wanna buy above 625, right? Like,
Yeah, absolutely.
Yeah.
Biggest niche for us is FHA buyer that's buying a high balance property,
Right.
729, and their debt ratio is above 50%. That's a huge niche for us because we priced out these scenarios 4.375 for a 729 loan
That's not bad.
with a 55 back-end ratio.
That's very
That's
good.
really good.
Yeah, so some techniques that you guys may want to try in your real estate business is if a borrower can afford to upgrade and they can carry 2 mortgages on the house, that's when this comes in. You get it? They have a house, they might be a little bit upside down, and they have the purchasing power. Maybe the husband's an engineer, wife's a nurse, power couple, and then they can afford to carry 2 mortgages.
What are the odds, huh?
Uh,
Nurse and engineer.
I've seen a lot of them. So because of that, they can
Oh,
buy the
kids.
Little
house.
kids.
They can buy the house.
There is one.
No kids in college.
Oh yeah, man. Really? Your wife's a nurse?
Yeah.
Huh.
I said,
Right
what's
there,
that?
engineer,
There
nurse.
was-
I didn't.
He said the kids in college.
That's somehow it works.
I know you worked this ahead of time, right?
So basically, they buy a house to upgrade. Maybe they short sell the other one later. You know what I'm saying? Maybe they short sell the other one later. So it's a good niche. A lot of people think if you want to upgrade, you can't buy a property, but there's a lot of good niches that you can. One other trick that I'll kind of give you a hint is if you have a buyer. Okay, we get in trouble if we say someone's going to live into the property and they don't move in, correct? Right? We get in big trouble. It's called a loan buyback. We don't like those. So one trick that you guys can use is if you buy a house as a rental property, we can still, on the banking side, we can still count the rental income. So let me back up a little bit. So let's say they got a townhouse. This is a true scenario. They got a townhouse. They got no backyard. Now they may want to buy another townhouse because it's so cheap. Okay? So they may want to buy this new house, and again, power couple maybe, engineer, nurse. They have saved up 25% down to purchase another house. 25% down. Well, they buy this new house as a rental property. You can actually count the rental income on the new property to help them qualify. Then, after they get it, after 60 days, they may want to move in. They may want to move into the rental property. Or they may want to short sell the other one later. Does that make sense?
Yeah.
You guys know what I'm saying?
Yeah.
Okay, so those are some tips and strategies
Creative.
that are creative. And the reason we can do that is because most lenders nowadays require 2 years of landlord history. So show me that you know how to deal with lots of rental property. Show me that you know how to manage it. But we can still do it on the banking side. We can still do it without that. We can have a brand new first-time investor coming in and still be able to qualify. Now, what if the new property is vacant? Doesn't matter. If it's a rental property, we go by the market rent. Does that make sense? As opposed to trying to upgrade and you have to check the equity, they don't have enough equity to qualify, so you don't have a deal because you have to have so much reserves. This is a
Yeah.
better technique and this is legit. Okay? Just make sure they move in, 2 months later.
In order for you, in order for you to buy your second home, can you use your 401k as a down payment?
Yes, you can. And some people are doing that. Because some people say, you know what, my current housing situation is so crappy, pardon me, so crappy that I just want to do something. I got the money in my 401k. Obviously, you're going to tell them when they're buying a house to what? Reduce your 401k withdrawals. A lot of people don't realize that. But where's all your money going? Well, 15% of my money, my paycheck, goes to my 401k. When you're buying a house, you can't touch it. It doesn't make sense, right? But if they decide that they want to adjust their housing situation, then by all means, it might make sense to take it from the 401k and then kind of readjust your market valuation.
But aren't you gonna get penalized for using that 401k as a down payment?
The 401k rules say you have to pay back within a certain amount of time. If not, you incur a penalty. So it's up to them. They have to kind of outweigh. If they got a current house that might be severely upside down or underwater, it might make sense. They have to weigh the cost of the penalty. But that's one strategy and trick that we use. So a lot of our business is FHA purchase business because of the high ratios. So we want to encourage you guys to get that business. It's out there. Okay? Talk to people. If they're unhappy with their house and they have good credit or they have lots of assets, it's a great opportunity for you to get them into an upgrade situation.
But if you have bad credit,
If you have bad credit, we don't go, if the banking side goes to 620, but bad credit we can go below 600, believe it or not, on FHA. It's gonna-
FHA or VA?
On FHA.
Okay.
VA 620 minimum, right?
That's correct. So, are there any other questions? Alright, let's see if this works. Hopefully it doesn't. Alright, cool. So, VA. So let's talk briefly about the VA Loan Guarantee Program. This is the actual name of the program. It's called the VA Loan Guarantee Program. So what VA does is kind of similar to FHA in that VA guarantees the mortgage to the lender. That means if the veteran does not pay for it, or the veteran's spouse, then VA will actually insure it. So a couple things that will stand out. Number one is there's no mortgage insurance. So remember we talked about HomePath? One of the advantages of HomePath was no mortgage insurance. The disadvantage was the rates are a little bit higher. So very similar, kind of a blend.
Do you have to, excuse me, Rich, do you have to be active in the military in order for you to qualify the VA loan?
I'm glad you asked that question, and it will be covered in the later slides.
Okay.
Alright, so throughout the history of our country has been a priority of the government and citizens to support those who protect and defend us as part of our military. All veterans are to serve a required length of service, which I'll go into, and an acceptable character of service. They can receive it. The benefit of the veterans, the underlying principle of this program. The VA can guarantee loan when it's possible to determine that the veteran has sufficient VA entitlement, is a decent credit risk, and has sufficient present and estimated income for repayment of the mortgage and other living expenses. These are the highlights. Because this is a very technical presentation, I've highlighted in bold the key points, so you guys hopefully don't get lost, okay? So, no down payment, 100% financing up to $1 million. Now there's some caveats, because Santa Clara County has a limit of $650,000. There's no monthly mortgage insurance premium. There's leniency on credit and employment history. That means that if there's a reason for a derogatory, they will take it with an explanation. There are no reserve requirements on single-family houses. On duplexes, triplex, fourplex, there are reserve requirements, but there are no reserve requirements. We use automated underwriting and traditional underwriting to calculate residual income and debt-to-income ratios. Now this is kind of interesting. The seller can actually pay the debt of the borrower. The seller can pay off the debt of the borrower, okay?
The
Now,
first and second?
the seller can pay off the borrower's debt, meaning their liabilities. In
Okay.
other words, they're desperate to sell the house, and therefore they, they can offer that. 100% of gift funds are allowed, and 2 years from Chapter 7, 1 year from Chapter 13. Now the bottom two guidelines reflect FHA. Our FHA rules are 2 years from Chapter 7 and 1 year from a Chapter 13, with sufficient history of good payments and of course court approval. So those are the typical highlights. Anybody know how this is different from HomePath?
Well,
What's different?
HomePath has to be owned by
Okay, thank you. So HomePath has to be owned by Fannie Mae, but also with HomePath, no appraisal is required. VA does require appraisal. Talk about that in a second. These are different product types. You got the 30 year, the 15 year, the 5/1 ARM, and you got the 5 year. HomePath had very limited product options. And the index it's based on is called the CMT index. Most of you will probably put people into the 30-year fix because the 30-year fix is so awesome right now, correct?
Yes.
Alright. Now with the 5-year, just in case, the 5-year you qualify the note rate, that's a pretty good niche. Okay, the 5-year is going to be in the 3s, but why would you get a 5-year if the 30-year is in the 4s? Regular and high balance loan programs, and we'll talk about that. High balance meaning loans above 417. And purchases at 100% LTV, what does that mean in English?
You can borrow the whole amount. Or
No
the
money
loan.
down, right? That means no money down.
Yeah.
Is that nice?
Mm-hmm.
Okay, now you can even cash out 90%. So if you encounter a veteran who's been in the house and has equity, they can cash out to pay out debt. Now, this is a good program, and if you guys focus on loans like we do, you know, I would write this down, but IRRL, that is basically like a loan rewrite. You guys ever heard of FHA Streamline? It's basically a no documentation refinance. Close in 2 weeks. Same thing with this.
Oh, I like that.
Not only no money down, but if you have a funding fee, it also pays for that, right?
That's correct. So, IRL, very popular program, very long acronym. But here's what it means. No income, no appraisal, up to 100%. Energy efficient mortgages, that's like a $6,500 program. I didn't really cover it too much in this slide. Now let's talk about eligibility, okay, because this is a very common question. A veteran is eligible for VA benefits if they serve in the Army, Navy, Air Force, Marine Corps, Coast Guard, Reserves, or National Guard, so I should say, and was discharged other than dishonorable, right? Makes sense? The minimum duty during wartime periods is 90 days. For peacetime periods, it's 181 days. And for members of the Reserves and National Guards, it's 6 years. Veterans who serve less than a minimum may be eligible if they have a service-related disability. Now, unmarried surviving spouses, i.e. widows of a deceased veteran who died, are also eligible for VA. I'll talk about that in
Wow.
a second. Pretty good, huh?
Wow.
I mean, if I knew this, I probably would have.
My friend
Found that
can
out.
use that.
Everybody say, wow, come on.
Wow.
Right? I guess this country does take care of you.
I put a lot of
Yes, sir.
check marks so far, so I'm like, you're doing good.
I love that.
Only the spouse of the veteran is eligible to co-borrow with the veteran. There is no co-signers. Okay? FHA allows co-signers, VA does not. There are some exceptions. Now, a non-purchasing spouse, okay, is acceptable, but you have to run the credit. This is similar to FHA. What's a non-purchasing spouse? Someone who is not going to be on the loan. Okay? You still have to get their information. That means if they're not talking to each other, you got to get the cooperation. You should, when you get married, and I can't say this because I'm not married, but when you get married, you should you should memorize your wife's social, I guess. Non-active co-borrowers are not allowed. We said that already. Power of attorneys. What are these used for? Let's say the veteran goes off to war, and they have a limited power of attorney to get signed. It must be approved by VA, okay, and of course escrow, and so forth. It has to be limited. You know which most power of attorneys are limited. Cannot be used for the initial loan application. The veteran actually has to sign the initial application, but of course it can be used for the final signing. At least one of the borrowers must be present, however, at the loan signing. Now, with regards to VA, we talk about certificate of eligibility. In my slides, I call this a COE. COE stands for Certificate of Eligibility. This must be ordered immediately or obtained directly from the veteran. I'm gonna show you how to get that in a second. Okay?
You can check with me, cause I've gone through that process in the last month.
Yeah?
'Cause I got mine August 1st.
The DD 214?
Yeah, I got
Good
that.
example.
Rich,
I got a copy
Uh,
of
so
the county recorder's office. Got it.
how high can you borrow money from VA loan?
I'm glad you asked that question.
Okay.
And my answer is,
650?
it's gonna be on the slides. It's
Yeah.
gonna be on the coming slides. Alright, so veterans that are purchasing primary residence must certify that they intend to live in the house. If a buyer is on active duty, a spouse may certify occupancy. Single or married service members deployed from the permanent duty stations are considered temporary duty status and are able to certify. Okay, so if they're in a duty station, they have to certify. Now, in October 2008, the President signed the Veteran Benefits Improvement Act. What this did was this kind of increased the values. The maximum guarantee amount in the U.S. is the greater of 25% of 417 or 125%. So I'm actually going to go through the calculation later. Regardless, the maximum loan amount is $1 million. Okay, but you'll see later on in this example that there really isn't a way to get here.
Only 417,000?
No, I'm going to show you in a second.
Okay.
All right. So this is how the VA guarantee percentage is determined. All right. This is kind of weird, and we really don't have to know too much about it because most of the time we'll be in this bracket right here. I highlighted here at 25% loan amount. Okay. So the VA guarantee, let me kind of put it in easier terms. It's a quarter. So think of it a quarter of a gas tank. The VA guarantee, for the lender to fund this deal, the VA has to guarantee 25%. So the 25% of the loan amount with a maximum of 104,250, this controls the actual purchase price. Okay? Unless you're here with VA Jumbo, you know, and then also the same 25%. I'll talk about that in a second. Regardless, the maximum amount is $1 million, but we never reach it here. So in this example, I put this for Santa Clara County. The VA limit is $650,000. The veteran has already used up $48,000. How to use it up?
By buying your primary residence before?
By buying a house before, correct? So he has a little bit left over. So we take the limit of 650,000. 25% of that is 162. We minus whatever's been used up. We times it by 4. That's the maximum amount that will be lent. Now in this example here, they're purchasing a house for 425. So therefore, the total amount that will be lent is 100%. Does everybody?
On my certificate it says 36,000, so,
36,000 is available?
yeah.
Okay, so we take 162 minus 36,000, and we take that number times 4, and that's the maximum
So it'll be
amount.
126 times 4.
Are you not buying 250 range?
Yeah.
Okay.
Yeah. I'm just trying to buy based on current income, not have to worry about,
Oh yeah,
Future
yeah. There's
income.
also an income qualification too. So
Why
talk about that in a
times
second.
4, Rich?
because again, the VA guarantee program is 25%. So the lender will fund it, and 25% of it is guaranteed. Okay.
Okay.
So I'll walk you through the calculation one more time. So in this example, the veteran has already used up 48 grand because they bought a house before, right?
Right.
So the purchase price is 425. We know that Santa Clara County, the limit is 650,000.
Okay.
That's what we looked up. We take 25% of this. We get this is the maximum amount that would be guaranteed. We subtract out what's been used up for what purpose?
Right.
Because they bought the house before,
Yeah.
right? So we get that amount of money, times it by 4, and this is the maximum amount that will be lent.
Okay.
If the maximum amount is less than the purchase price, that equals the down payment. Does that make sense? All right. Of course, you don't have to worry about that. We do all the calculation for you. We also do all this stuff too. But if you want to register, then this website will be in the later slide. I'll show you where. Okay.
Okay.
All right. So let's talk about COEs, certificate of eligibilities. There are different colors. Regular full-time active duty is green, reservist National Guard is gold, and surviving spouse or widow is green. Now, the
Okay.
ACE is computer generated. So, this is where you can get it. I don't know if you went here, Ken, did you?
Huh?
Did you
Yeah.
go to this website? Okay. So this is the website we can get it. HTTPS, blah, blah, blah. You choose eligibility. We'll take your client through it if you have a client. Don't worry about it. We'll take your client
Okay,
through steps.
good,
It's
good.
kind
I
of,
submitted mine like on a Friday or on a weekend. I got it on
Yeah.
Monday.
you should
Like,
get it right
Oh,
away.
that was-
just a few
Quick.
days.
Yep, you should get it right away, except unless you're one of these people. So if you served in the Reserve or National Guard, or if you had a prior VA loan that went to foreclosure, i.e. risk, or if you did not serve the minimum of required service, or you were discharged dishonorably, or you were trying to restore previously used entitlement, meaning that you bought a house before and something got messed up. Or
But if
you're-
you already sold that before, or if someone already bought it and it closed your previous loan, it cleared your previous loan.
Yeah, you still have used up your entitlement. So, you still have used up your entitlement.
Okay.
Now, the unmarried surviving spouse, here's what you can do. The certificate of eligibility does not require it can be used again and again. If the veteran does
Okay.
hold a valid eligibility, you can assume that he or she has done the appropriate length of service. And as I mentioned before, lenders do require at least 25% of the loan to be guaranteed by VA.
Okay.
And it is possible in some cases to show an amount less than $36,000.
Okay.
Again, I highlighted the bold part because this stuff isn't like a lot of trivia. Now let's talk about the funding fee, okay? Because this is the hardest part when you're dealing with real estate. This is the hardest part to negotiate. The funding fee is a charge that veterans pay to use the VA program. Okay, the funding fee is based on the full loan amount. There are certain veterans that are exempted. People that have disabilities, they're exempted. People who are surviving spouses, i.e. widows, are also exempted. People who would be entitled to receive compensation for service-connected disability are also exempted. The VA funding fee may be financed, paid by the veteran, or paid by the seller. So typically, what I've seen, the hardest is getting the seller to pay for it. Getting the seller to pay for the VA funding fee, because a lot of times the person, the borrower doesn't have the money. But it's doable. It's just a subject of negotiation. So we're gonna talk about how much it is in a second. Okay, on a high balance loan, the fee can only be financed if the loan amount and funding fee are less than the maximum amount for the county. So don't worry about that, we'll calculate for you. I highlighted here the most typical common use. On your first time use, if your down payment is between 0 to 5%, the funding fee is 2.15. And that's probably what you should know. 2.15 if you're buying a single family house and your down payment is between 0 and 5%. Of course, the second time you use the VA program, it's a little bit higher. And there's some differences between National Guard and regular military, but the most common one is the top one. Did you
And this
serve-
applies for refinance also?
That's correct. And the interest rate reduction refinance has a small fee of only 0.5. Alright, a lot of technical stuff, but don't worry about it. We'll take care of all that stuff. I just want you to just get the gist of it. Alright, if the borrower is exempt, meaning that it's one of those three categories, then you have to fill out a form, which we'll take care of. And then there's a award letter that gets issued, which has to do with disability compensation. Okay, so if you're a disabled vet, no VA funding fee. Alright, this is just how to take an application. You ask the veteran if they're receiving the benefits, or if they would be entitled to receive it, but instead receive retirement pay, or if they've received the disability benefits in the past, or if they're a surviving spouse or widow of a veteran who has died on active duty. Then we have to submit the form, and the form will actually go to the Department of Veteran Affairs, and we'll get a letter of certification.
Good.
Alright, so maximum loan amounts. Again, the highlights is right here, purchase 100%. I'm going to pass out this matrix as well for you guys to have.
Rich,
You have enough?
here, yeah,
Okay, great.
more than enough.
Alright, so let's take a look at this matrix. This is a kind of little handy dandy sheet that you can work off of. For example, in the middle, it covers the eligible borrowers, okay, the type of service that they're in, and the required years. This is the slides we just covered. It covers the contributions from the seller. On the bottom left side, you can see the funding fee table that I showed you earlier. And again, the most common one is the 2.15%. And for the category on the left side, right in the middle, talks about the entitlement guarantee. If we fit into the 417,000 category, we can see that the guarantee is 25% of loan amount. Everybody with me so far?
No,
Okay. Slow down. On the left side,
okay.
we can see on the table that if the loan is between 144,000 and 417,000, the guarantee is 25% of the loan amount. Okay, everybody see that?
Yeah,
So that's how we do the calculation. On the very top, we can see that the credit score. We can see that if the loan amount is 417, we can go to a low 620 credit score. If the loan is above 417, this is called high balance, we need a 720 score. Okay. So this is a handy dandy sheet. The only thing I'm going to also point out is on the right side where it says DTI ratio, which I'll go through in a second. 41% is the maximum debt ratio on a manual underwrite. Now, as I told you in most of our presentations, we're pretty good at tweaking the system, right? So we can go typically up to 45, maybe even 47 on the back end ratio. So if it's a manual underwrite, meaning if the system doesn't like it, it's a 41. But if we can get it through the system, we can look between 45 to 47. Okay? Now I also have some links on the bottom right where you can go to read about the VA and look up actual county limits. I forgot what county Stockton is in.
San Joaquin.
San Joaquin.
Yeah, so you can look up San Joaquin County, etc.
Rich, what's the underwriting method says 640 minimum credit score?
Basically, okay, VA itself has a 620. There's an overlay of 640. There is, behind the scenes, there's something called an exception matrix that we go off of. So if the borrower is very strong in terms of good credit or good reserves, then we can always go down to the 620. Okay, so it's kind of like a overlay, if you will.
Okay.
All right, so let's move on. So we talked about the LTV limits. We can remember that the purchase has no money down on either the high balance or the low amount. We can see that the property types that are approved are single family, PUDs, approved condos. And I'll show you what that approved means in a second. Stay away, basically. The documentation means run it through a system. Now reserve on a typical loan between 417 and also higher is no minimum unless it's a more than one unit. Okay, so it's a pretty good program.
it is.
Now, let me see if you guys are paying attention. Home path. Home path, one of the requirements, as you said, is what?
No appraisal.
I forgot already.
Oh, you forgot? Jeez. No appraisal. What else is a home path? Fannie Mae owned properties, okay? VA? What type of property?
That's of anything.
Any property.
PUDs,
Properties.
condos,
Oh
two
my
to four
god,
units.
that means his new listing is eligible for VA financing. See, so that's pretty powerful. This home path, you're restricted to certain properties.
Yeah.
So, condos have to be looked up. You have to actually check the VA site, which again is on your bottom right of the flyer I just passed out. So my advice, single family homes are really cheap right now. Stay away from condos. Unacceptable properties are manufactured homes, co-ops, modular homes, properties that are veteran owned, VA owned, okay, where the veteran foreclosed. For some reason they don't want to let another veteran take over. Kind of a weird rule. Properties that have well water and septic systems. Okay, I have not encountered any, unfortunately. Now we show this map here. This is something that you might be interested in, but Did you notice that California is very heavy to termite risk?
Holy
This is
cow.
termite risk, okay? So, notice a trend, right? So, because of that, you're gonna have some concerns about termite. You may have to get a termite clearance. Now, this is a little caveat here. Sometimes this happens. I don't think it's a big deal, but if you renegotiate the purchase agreement because of something, and the appraisals are even done, you're gonna have a hard time to get more money. Okay, so don't renegotiate the price unless you're, for certain. If you do renegotiate the price, the amount that will be lent is going to be the lower of the original purchase price. Okay, I hardly know of a case where you would do this. With FHA and conventional, we've been lucky because most times the underwriters are pretty cool with it. But just don't renegotiate the purchase price after you send us the purchase contract. Now, one thing I left this in here, even though it's very technical, but it says basically in English that the purchaser shall incur a penalty, i.e., lose their deposit, if for whatever reason the purchase price exceeds the value of the property. Okay, so it's kind of like a what? Which with the A? What? No.
What did you say?
Was
The
it-
purchase price exceed
So
the.
if the purchase price exceeds the value of the property, the buyer doesn't lose their deposit. What does it sound like? Some kind of contingency? No? What? Sorry, what?
Appraisal.
Appraisal contingency? You got it. Ah.
Yeah.
Okay. So that's pretty cool. That means that even if you don't have a negotiated appraisal contingency in your purchase contract, the Veteran Administration will require the buyer to buy it, and they cannot lose their deposit. Does that make sense?
Mhm.
Okay, so they're protected. By the way, it's the same thing with FHA too, just so you know. Appraisal form 1004, that's a normal appraisal form, so don't worry about that. They may require an appraisal review. We haven't had any requirements on that recently. Flipping. Anyone know what flipping is?
Yeah.
Selling it after buying,
What?
selling the property
Selling.
after
Very
acquiring.
fast.
Fixing the house and
Okay.
resale it, resell it.
Okay, good. Selling it, let's say they buy it at an auction, they acquire it, and they try to sell it within 90 days. That's called flipping. Sometimes it's done legitimately, sometimes